In today's session, we will discuss about accounting and cost. Page number 25. You have the textbook, page number 25. Accounting, economic, and opportunity cost. Okay. So, what is the definition of cost? An amount that has to be paid or one that is given up in order to get something. And in business, it's not always about money. You give something up to get something, that is cost. Okay. Whatever you are giving up in order to get something is cost. So effort, material, resources, time, utilities consumed, risk incurred, okay, opportunity forgone in production, and delivery of goods and service. Okay, all these comes under cost. Okay. It's not always about money. And there are three different types of cost in finance: accounting cost, economic cost, and opportunity cost. Accounting cost are the actual or outlay costs that point out the amount of expenditure that has already been incurred. Okay, for example, if you are planning to build a hospital or run a clinic, okay, you have to spend some money in the area, like buying a land or renting a land or leasing out a property. The money that you have already given for lease, okay, the cost of purchasing. These are cost expenditures that have already been incurred, okay, on a particular process or production. That is what we call as accounting costs that have already took place. The expenditure that is not, it cannot be neglected, okay, it has to take place. So that is accounting cost. So different types of cost which are used in business. One is direct cost, indirect cost, fixed cost, and variable cost. So direct cost, they are related to producing of goods and service. It is the material, labor, expense, or distribution associated with producing the product. Okay, which cannot be forgone. Direct cost, like if you want to make a cake, you have to buy the flour, the sugar, butter, all the ingredients you have to buy. Only then you can make a cake. Okay, so that is the purchasing of goods to do a process or continue a manufacturing. So they come under direct cost. It can be accurately and easily traced to a project, to a product, department, or project as well. Okay, we know that when we give budgeting, okay, budgeting is also you're giving a part of your cost to a department, and that department has to run throughout the year using that budget. Okay, so they will be spending that budget on various things. So whatever things they're spending it on, they become the direct cost to the company. Okay, discounts on purchase that you give, that is also direct cost that you incur. Okay, if you are selling something on a discounted rate, okay, the discounted rate is also a cost. Transportation expenses, wages, purchase expenses, okay, they all come under direct cost. Costs that are directly linked with the manufacturing or service sector, that is direct cost. Indirect cost, an expense unrelated to producing a good or service. Okay. And this cannot be easily traced to a product department or activity. You can't trace it from where it came. How did this happen? You can't trace it. Okay. For example, electricity used to power an entire building. You can't trace it completely. You have to pay the electricity bill. That is indirect cost. Okay. salary that you pay, wages that you pay, so they all come under direct cost. Insurance that you take. Then you have fixed cost, fixed expenses. Advertisement expense, insurance of stall, rent, small deposits that you make. Okay, those are fixed cost. They do not vary. Every month you have to pay. For example, rent. Okay, every month you know the rent what you are going to pay. EMIs. Okay, they all also come under fixed cost. Variable cost, duties that you put on sales, tax, labor charges, miscellaneous expenses. They're variable. Every month you have variable cost, but you do not know how much you will pay. Okay. Every month it is a different scenario. That is variable cost. Also, if your manufacturing sector or service sector is in a seasonal situation or a cyclical situation, variable cost would change over a period of time. Then operating cost. These are the costs associated with day-to-day business activities. It could be variable or fixed as well. Okay. And for example, let's say if a company is producing or selling microchips, these microchips can be stored or maintained. That is an operational cost. It can also calculate the company's operating expense ratio as well. Okay. Day-to-day expenses like petrol, or if you labor wages for laborers on a daily laborers that you get, okay, on a contractual basis, daily laborers, telephone expenses, internet expenses, office supply like A4 sheets, pens, markers, okay, legal expenses, they vary on a day-to-day basis. Economic cost, it includes both accounting cost and opportunity cost. Accounting cost we have seen, okay, direct, indirect, fixed, variable, operational. They all come under accounting cost. Okay. Uh, these are explicit cost. Opportunity cost is implicit, which means it hasn't occurred. It's more of a thought process. Okay. And you will see here what is opportunity cost. So it means a value of the next highest value alternative use of that resource. The second best option, what is the cost of it? Because you're leaving that. Okay, when you have two options, you have to make a choice. Okay, so the cost of leaving the second choice is what we call as opportunity cost. Okay, the benefits you miss when you make a choice, that is opportunity cost. For example, on screen you can see there is $100. You have two options of spending. Either you spend it on shoes, or you spend or you invest it at 5%. Okay, so if you are buying the shoes, you are spending the entire $100, but if you're investing it for 5%, you will be gaining $5 extra. Okay. So the difference between these two options in terms of cost is just $5. That $5 is the opportunity cost. Okay. How is opportunity cost used for people? They for at an individual level, it can help them understand the very best way of using their money and time. Okay. The second situation is companies use it to make more products, replace equipments, paying and dividends and all. For example, another example, you have two alternatives, alternative A and alternative B. Okay. one is 40,000, one is 35,000. What is the difference between these two opportunities? Just 5,000. Okay, 5,000 is the difference between these two opportunities. So that is the opportunity cost. Okay, the cost of leaving one item over the other is 5,000. Return of investment, from the name itself, you can understand what it would be. Return of investment, you have invested some money and the remaining and whatever you have invested, how much you are getting back after calculating the cost and everything. Okay. After calculating the cost and everything, whatever remains back is your opportunity cost. Sorry, it's your return of investment. So net profit is that whatever revenue you have made, after the revenue, whatever remains, after the expenditures and all, you calculate, and whatever remains, that is your net profit. Okay. So that is the numerator. Cost of investment is the denominator multiplied by 100. Okay. Profit centers, these are the departments in the hospitals which are capable of making profits. Okay. Directly, the payment is coming to this department. Okay. So like, for example, surgeons, doctors, okay, whatever service they give, it is directly paid to them. Okay, or even at the billing department, it is the payment is received by the service that this doctor or surgeons have given. Marketing team as well. Okay, you invest very less amount of time in the marketing department, or very less amount of employees you hire for the marketing team. Okay, but the amount of benefits that they bring through the various types and everything is quite high, right? It is quite high. So that is about the profit centers. Any department in the hospital that generates its own specific bill is a profit center, like laboratory, OT, ICU, radiology department. Okay, anywhere where diagnostics are done, okay, they become your profit centers. Cost centers, they don't directly bring any money or any billing. Billing is not done under these departments, but you have to spend money to keep them. That is cost center. Okay, like HR department, administration, nursing department, research and development department. Okay, they come under the cost centers. So this is the cost centers, profit centers, and investment centers. Investment centers you have are at the highest level of management. Okay, they decide where to invest, how to budget. Okay, the top management usually comes under investment centers. Profit centers are middle-level managers. Okay, they are also an integral part in decision making for the hospital. Okay, but they are middle-level managers. Operational management or supervision comes under cost and revenue centers. Revenue means they collect the money, but there are some expenses as well. Okay, like the billing department, they collect the money. Okay, but that money is not just profit. You have to reduce the expenditure as well. Okay. That is revenue and cost centers come under operational management. Day-to-day supervision, day-to-day billing is done. Okay. This comparison is not required. So that's about accounting